Now let's talk about other risk as well. Other risks. So you have other risks like economic risk and transaction risk, right? So when we talk about economic risk, what do we refer to? Economic risk basically refers to the long-term movement in exchange rates caused by changes in competitiveness of a country. Now note the keyword here. The keyword is long-term movement. It's very, very important. It's the long-term movement in exchange rates caused by how competitive a country is. For example, over the long term, the euro might increase in value against the US dollar, right? If the euro increases in value against the US dollar, what will happen? It would mean that goods that are produced and paid for in US dollar will become cheaper relative to goods produced and paid for in euros because the euro has appreciated. The euro appreciates against the US dollar. What will happen is that the US dollar will decrease in value and therefore goods in the US dollar will become cheaper. Very, very important. US companies will therefore become more competitive in terms of price relative to companies in the Eurozone because of the exchange rate movement. So because the value of goods, the price of goods in the US dollars will become cheaper, in that sense, the US becomes more competitive in terms of price compared to companies in the Eurozone because of the exchange rate movement. So let me go through the example again. Over the long term, the euro might increase in value against the US dollar, right? That happens. Produced and paid for in US dollars will become cheaper relative to goods produced and paid for in euros. US companies will therefore become more competitive in terms of price relative to companies in the Eurozone because of the exchange rate movement. I hope that makes sense. Economic risk in the context of foreign exchange is therefore the risk that a company might choose to locate its operations in a country whose currency gains in value over time against the currency of its competitors in world markets. The consequence of an increase in the value of the domestic currency is a loss of competitiveness. Very, very simple and very explanatory, right? So look at economic risk in the context of foreign exchange. It's basically the risk that a company will choose to locate its operations in a country whose currency gains in value over time against the currencies of its competitors in world markets, right? So we are looking at economic risk. We are looking at it, in terms of the competitiveness of a country, in terms of the competitiveness of a country, right? So you might have realized that when organizations are making decisions, they go to certain kinds of countries, right? So they locate their operations in a country based on how competitive the country's currency is. And this is a strategy that organizations use a lot. Because once a currency becomes extremely expensive, that country loses its competitiveness in terms of price, in terms of the price of their goods, So that's why I said here, the consequence of an increase in the value of the domestic currency is a loss of competitiveness. Very crucial. Now let's move on to transaction risk. So transaction risk is basically the forex risk that arises in transactions between two parties. It's a forex risk that arises in transactions between two parties. Very important. Now, what does this even mean? When we mention transaction risk, obviously what comes to mind is risk-related transactions, right? But I put up a definition here, which I think is very, very helpful. It's very, very helpful. So transaction risk is the risk that for a future transaction in a foreign currency, the amount received or paid in domestic currency might be different from the amount originally expected because of the movement in exchange rate, the date of the initial transaction and the date of settlement, right? So when two parties are entering into a transaction, right, there's usually an initial transaction date and a settlement date. So for example, let's say someone is into buying iron rods. There would be an initial transaction date where the details of the transaction is agreed. Then the supplier gives the buyer about 30 or 60 days to make the payment, right? Now, within the initial transaction date and the date of settlement, a lot of things can happen. There can be a lot of exchange rate movements within that period. So it's important to understand this risk, right? So let's say at the time of the initial transaction date, Kofi in Ghana wants to purchase iron rods from China. At the time of the transaction date, or the initial transaction date, the cedi was appreciated relative to the Chinese currency. But Kofi was given about 60 days to pay, and within that 60 days, there was a shift. The Chinese currency began to gain momentum, began to appreciate against the cedi, right? And so this exposed Kofi Menu, who is iron rods dealer, because of the exchange rate movement that happened between the initial transaction date and the settlement date. Now I give another example here, so let's go through that example. For example, transaction risk will arise when a UK company buys from a Chinese supplier when the price is in US dollars. And payment is required 3 months after the date of the purchase. So do you see? Currency involved is a foreign currency. And there's some form of gap between the initial transaction date and the settlement date, which therefore exposes the parties to the transaction to exchange rate movements. I hope that makes sense. Now, we talked about risk. We haven't talked about risk management yet, because the whole aim of trade management or cash management is to be able to hedge against risk or manage risk. So when you hear hedging, think about it this way. When somebody mentions a hedge, what comes to mind? A hedge is basically a medium of protection. A hedge around someone, or a hedge around the home. It's basically a mechanism of protection. So when we say hedging is simply a risk management technique that protects individuals and organizations. So think about it that way. The purpose of hedging and exposure to risk is to eliminate or reduce the possibility that actual events will turn out worse than expected. So there are times where you can eliminate a risk, and there are times where you cannot. So the whole purpose of hedging is to either eliminate or reduce the impact of the risk. The purpose of hedging exposure to currency risk is to remove the possibility that a future transaction involving a foreign currency will have to be made at a less favorable exchange rate than expected. So the whole purpose of hedging is to either eliminate or reduce. So basically, that's where managing risk comes. It's either eliminate or reduce the frequency or the impact. Two things. You're reducing the frequency or the probability and the impacts of the risk. Exchange rates can move up or down, and spot rates could move favorably as well as adversely. However, many companies prefer to hedge their currency risk by fixing an exchange rate now for a future transaction, even if this means that you'll not be able to benefit from any favorable movement in the exchange rate. So because of these exchange rate movements, companies and even people would like to hedge, and would like to protect themselves from these exposures. So the example we give in transaction risk, right, where we said there's usually an initial transaction date and a settlement date, right? One way of protecting yourself is to agree a currency or fix a currency at the initial transaction date, so that when there's any change or movement in the currency after, it does not affect you, right? So let's say at the time of the initial transaction date, the US dollar to the Ghana cedi was, so you need about, let's say, 7 Ghana cedi to get $1, right? People want to protect themselves against exchange rate movements, or agree with the supplier to fix the currency exchange rates at 7-1, right? At 7-1, so that if the cedi continues to depreciate up to the time of the settlement, they are not affected. So what are the methods? We'll be talking about this more extensively, but what are the methods of hedging exposed to foreign exchange risk? What are the methods? The most important methods of hedging exposures to currency risk, which you will be expected to know for the definition, are matching receipts and payments, netting receipts and expenditure, forward exchange contracts, creating a money market hedge, currency futures, options, and swaps. So let's take them one by one. So let's talk about matching receipts and payments. Matching receipts and payments. Now, what does this mean? And this involves matching foreign currency receipts and payments in order to reduce transaction risk. So when a company expects to have future cash receipts in a foreign currency and make future cash payments in the same currency at about the same time, it can use the receipts to make some or all of the payments. So this is basically matching, right? Let's say a Ghanaian businessman is doing business with Chinese in China, right? And this business they are doing is two-way, right? So the Ghanaian businessman has to make a payment to the Chinese businessman, right? And the Chinese businessman also has to make a payment to the Ghanaian businessman for some service he provides him. So look at it this way. What will happen is that, okay, so let me give you some goods here so that it becomes clearer. So a Ghanaian businessman buys children's clothes from a Chinese businesswoman and sells them in Ghana. Now they have a very good relationship. So the Chinese businesswoman also has a relationship with the Ghanaian businessman, and also tries to buy, let's say, cocoa pods from the Ghanaian businessman, because this Ghanaian businessman also has a cocoa farm. Now, the Ghanaian businessman goes ahead to make a purchase of a huge stack of children's clothes for about 100,000 Chinese yuan. And the Chinese businesswoman also makes places a transaction with a Ghanaian businessman to buy cocoa pots for about 80,000, for about, let's say, for about 200,000 Ghana cedis. Right. Now, what these two business people could do is receipts and payments. They can match the receipts and payments, and it will reduce the exposure to risk. Now, that's what I mean here. When a company expects to have future cash receipts in a foreign currency, so when a company is expecting some foreign currency coming in and future cash payments in the same currency at about the same time, can use the receipts to make some or all the payments, or all of the payments, right? So here, the Ghanaian businessman will say, oh, you know what, you owe me 200,000 Ghana cedis, and I also owe you 100,000 Chinese yuan. Rather, I send you the 100,000 Chinese yuan and you send me the 200,000 Ghana cedis. Let's basically net this off, right? So that we reduce our exposure to risk. To the extent that future receipts match future payments, foreign exchange risk is eliminated. The spot exchange rate will affect the net receipts and payments equally. The loss from the adverse movement affecting the cash receipts or payments will offset by the gain from the favorable movements affecting the cash payment or receipts. Now, I've explained the concept extensively, but let me repeat myself one more time. In matching receipts and payments, you are basically taking receipts you expect in a foreign currency and matching it against payments in the same currency at about the same time in order to minimize foreign exchange exposure. It's very important. Now let's move on to netting. Netting can be applied to assets in a foreign currency or to assets and liabilities denominated in a foreign currency. It's a process which involves netting credit balances against debit balances so that only the net amount is transferred or left as outstanding. The aim of netting is to save transaction costs by reducing the size of the foreign currency transfer. Now, in matching receipts and payments, you see clearly that the foreign currency is matched, the expected of foreign currency receipt is matched against the foreign currency payments. Now, in netting, what we are doing here, you are netting credit balances against debit balances so that only the net amount is left to be transferred. I hope that makes sense. Right? Very, very important. Now let's move to interest rate swap. Now, when you hear swap, a swap is like an exchange between two people. So an interest rate swap is an agreement between two parties, such as a company and a bank that deals in swaps for a period of time that suits employer. So swaps, therefore, are long-term agreements on interest rates. Long-term agreements on interest rates. In a swap agreement, the parties agree to exchange. See, I talked about exchange. To exchange interest payments on additional amounts of principal at agreed dates throughout the term of the agreement. So when you are saying you are swapping interest rates, what you are doing is you are exchanging interest payments. Exchanging interest payments. So how is this done? How do we exchange interest payments? The interest payments that exchange in a coupon swap are as follows. One party to the swap pays a fixed rate, and the other party pays interest at a reference or benchmark rate, such as LIBOR. So LIBOR is simply the interbank offer rate. So one person will pay a fixed rate, and the other person will pay interest at a benchmark rate or a reference rate. So what's the whole purpose of an interest rate swap? The purpose of an interest rate swap is often swap a variable rate of interest payments or receipts into a fixed rate payment, and also swap a fixed rate of interest payments into a variable rate of interest payments. So here, we know that loans have different kinds of interests or types of interest payments. Some are fixed interest rates and some are variable interest rates. So in an interest rate swap, you can swap your fixed interest rate for a variable interest rate and vice versa. Right? And vice versa. So, and there are different reasons why the swap might become necessary. So for example, when you hold a loan in a time when inflation is high, inflation decreases the value of money, right? Because your money is able, in an inflationary period, your money is only able to chase fewer goods. So it decreases the value of money. In an inflationary period, when you have a loan, the value of your loan is essentially decreased, right? And so if the interest rate on that loan in an inflationary period is fixed, right? It's fixed, that goes to your advantage as the borrower. It goes to your advantage as the borrower because the interest payments you are making in terms of value will be lower because of high inflation. So the purpose of an interest rate swap is basically to swap the variable rate of interest into a fixed interest rate payments, and also swap a fixed rate of interest payments into a variable rate of interest payments or even receipts. let's talk about forward contracts. A forward exchange contract is basically a contract entered into now for a settlement at an agreed future date. That's forward. Remember, when we're talking about transaction risk, we said that there's an initial agreement date and there's also settlement dates, right? Now, what a forward exchange contract intends to do is it enters into a contract now for a settlement at an future date. So they agree on the exchange rate now for a future settlement date. This is to eliminate any form of exchange rate movements, the impact of any exchange rate movements after the initial transaction date. It is a contract between a customer and a bank for the purchase of a specified amount of a specified foreign currency for delivery at a specified future date, at a specified rate. So let's give an example. Now, a forward contract is simple, right? Let's say I want to import oranges from Nigeria. I'm a Ghanaian businessman, I want to import oranges from Nigeria. Right? Okay, so, and I understand the movements in currency between the cedi and the naira. So I have spoken to a company in Nigeria who is willing to supply the oranges, right? But they've given me 30 days to make the payment, right? Since I'm, wary of the exchange rate movements, at the initial transaction date, I'll agree with the company in Nigeria to fix the exchange rates. So that whatever exchange rate occurs at a certain date doesn't apply to the transaction. It is what we agreed on the initial transaction date that was done. And so it eliminates any form of exposure at the initial transaction date. So these are some of the hedge techniques that are used to basically hedge and protect against risk. Thank you very much for watching. And if you have any questions, drop them in the comments section and I'll respond to them. If you haven't subscribed to this channel as well, please subscribe and share this video with your friends. Thank you.